and welcome to this Investor Forum in partnership with investment research and advice company Hardman and hosted on Spark Live. As Peter said, I'm Amy Smith and I'm part of the London Stock Exchange's Sustainable Finance team. Today, you'll hear from companies spanning different sectors that all have one thing in common. They're all recipients of London Stock Exchange's Green Economy Mark. The Green Economy Mark is an accreditation that's given to London-listed issuers that are making a significant contribution to the global green economy. Through their products and services, they're helping meet environmental objectives like climate change mitigation and adaptation, waste and pollution reduction, a transition to a circular economy, and sustainable agriculture. To receive the accreditation, companies and funds must be able to demonstrate that over 50% of their revenues are derived from green products and services. They can receive the mark in a couple of different ways. So they can receive it as part of their IPO process. They also receive the mark if they're covered by FTSE Russell's Green Revenues data model, or they can apply directly to the Sustainable Finance team. We now have over 108 companies and funds in London with a combined market cap of 156 billion that have the mark. Green funds represent nearly 1/3 of this cohort and are the biggest constituent sector. Their market capitalization has grown by 76% in the past 2 years. And if Green Economy Mark issuers were classified as a sector in their own right, they would be the fourth largest, in terms of capital raising since 2020, despite only representing around 5% of all London listed companies. We are proud to have represented in the cohort companies from across many sectors, some of them that you will hear from today, all of whom are contributing to a greener future. So I'm hoping that's given you a good overview of the Green Economy Mark and its relevance to investors and also corporates. I'll now hand over to the Hardman team to begin the presentations. Thank you very much.
Amy, thank you very much for that. And can I have my warm welcome to everybody today? Thank you for joining us. My name's Keith Hiscock and I'm the Chief Executive of Hardman Co. These forums give investors the chance to hear a company's investment case and question the management. As Amy said, the main feature today is companies which qualify for the London Stock Exchange's Green Economy Mark. We've got presentations from 3 companies, be approximately 15 minutes long, followed by 10 minutes of questions and some polls alongside that. And then we'll follow that up with a panel discussion. So the first company presenting today is Considerably. This provides investors with the chance to invest in smart technologies and smart meters and the communications web associated with them. Smart meter rollout is becoming a priority around the world for fairly obvious reasons. For example, in India, there are plans to replace 250 million old meters in the next few years. Considerably recently completed a fundraising to support their growth, and the DCF valuations are well above the current share price. We've got 2 speakers today. We've got John Cronin, who's the Executive Chairman, and we've got Heather Peacock, who's the CFO. John, over to you.
Thank you, Keith, and a warm welcome to everybody that's on this call. I do appreciate you giving the time today. So without further ado, if we just go through the presentation. So on to the next slide, please. And the next, yeah. No forward-looking statements, as you can all appreciate. We could spend all our time reading that statement, but I think you're all used to that. So let me just kick off and talk about really the investment case and why should you look to invest in Considerably, and why would you want to continue investing in Considerably? First of all, we're headquartered in Cambridge in the UK, where we've got some very intelligent people, the clever clogs of the business, the PhDs, that really have designed the software, the hardware, and the services for our product. We have spent something like over the last 10, 12 years, something like $50 million on the product, and the product is fully baked, as I would say. There's some integration and small add-ons that we'll do as we move forward. And we go to market through multi-billion-dollar companies and organizations such as Schneider, Genus, IntelliSmart, Adani, Reliance, for instance. And we offer a full end-to-end solution, which is really important in delivering a quality product. Our focus today is on electricity smart metering, and we operate and look at businesses, in the UK, in India, Sweden, Thailand, some African countries, and the UAE, in particular Dubai, and also Abu Dhabi. And we can, do and offer gas, water, EV chargers, smart cities, but we're so busy with electricity at the moment. That's the real focus as a here and now and the short-term revenue streams for us. So as Keith has mentioned, in India alone, by 2025, the vision for the Indian government is to roll out 250 million smart meters. Today, there is only 4 million smart meters that's been deployed, of which Cyanode today has between 22 and 25% of that market. The rest of the 75% circa is actually from a government organization called ESL and IntelliSmart, and they were given under a nominations basis, government to government. In other words, they didn't have to tender for that. They were given those to roll out the smart metering, albeit on cellular. And of course, what you have to do is have a performance level of 99.5% of getting the data from point A to point B. And that's what we offer an RF mesh. Cellular offers something between 95 to 97%, so it doesn't quite hit the mark in terms of what it is that the government look for. If you look at the market as a total, it's about $80 a point. That includes the communications, includes the meter billing software, and includes the meter itself. End-to-end point, about $80 a point, and that's a market worth of about $20 billion. So it's a huge market that's out there, and really there's still 250 million to go at. And all of this requires significant investment, and this is being done now by companies coming in to set up special purpose vehicles where they fund it, and actually the utility then, instead of paying $80, will pay per meter per month over 8 or 10 years. And that's quite significant. If you then strip back and say, what's it worth to us as Cyanode, I predict in the next 5 years, conservatively 20 to 30 smart meters of the communications, and that's worth to us around about $400 to $600 million, depending on the deal that we can do as we move forward. Excitingly, today there's actually 41 million of those 250 out there up for grabs under tenders at different stages. Up until this year, we were only talking about hundreds of thousands of units, not millions of units. So you can see the inflection point that we've had. 775 million in revenue is that opportunity. And I'm not saying, by the way, we're going to win all of that, but if we can win some of the crumbs off the giant's table, we'll be delighted with that. Worldwide, we've got an opportunity pipeline at 840 million. And as I mentioned, those countries earlier on that we operate in. So this next piece, the USP as we call it, why do utilities, Discom want Cyanode? Well, first of all, we're an international standards-based product. As I mentioned, delivering 99.5% performance. And basically, we're a very secure network. So I'll give you an example of that. When you come out of a football match, rugby match, cricket, try and use a mobile phone. At times, that tower where you're trying to make the phone, that cell, is blocked. You can't take all the phone calls. We dimension the network to be able to take 100% data throughput all of the time. We're also meter agnostic. We can connect any device in the world in the neighborhood network. What we have done in the last year or so as well is move primarily not just 100% RF, but we can offer some cellular, NB-IoT, and powerline communications through our platform. And we're always looking at innovation like long distance radio to go up to sort of 10 kilometers instead of the 4 kilometers. And worldwide, we've deployed something like 2.7 million units to date. Next slide, please. So, what's really this point is saying to us is that, it is a platform, and that platform can take any device, can take EV chargers, smart lighting, gas and water as well, and that we are and do have blue chip partners that go to market. Next one, please. So just to give, for those people who don't know Cyanode, I'm sure there's a lot on here that are very familiar with us. On the left-hand side, those are the meters in the homes, and we connect 250 different homes to one data concentrator unit that's in the middle there. So 250 to one data concentrator unit, and we backhaul that then over mobile or fiber. We then provide some software called head-end software in the billing system of the utility. And from the hardware, the software, and the services that we offer, it's a full end-to-end solution. And we do all the integration from the meter and integrate into the meter data management system, the billing system. And therefore, we can actually look at rows and rows of meters in call centers. We can control them, offering time of day tariffs. We can do net. A lot of people have got solar panels, and those panels will actually deliver into the grid, and we can net that off the bills. People that don't pay the bills, we can remotely switch them off and then get them to pay onto prepaid metering. And actually then we can make sure that the utility, collects the cash. I mean, today they lose something like $32 billion a year where they've generated electricity and not collected that cash. Our system helps collect that cash, also helps for non-payers. Actually, one utility, we've just seen the results where they were collecting cash of 63% a month. With our system in 2 months, went to 88%. So helps cash collection as well. The next slide, please. Here it looks at, why are we cost competitive? Well, we're cost competitive because we use unlicensed spectrum, and this is called ISM bands. This is the same bandwidth that actually, if you've got a key fob that opens up a garage door or electric gates, that's what the power. That's what we use as the ISM band, and that is globally around the world and what we call sub-gigahertz. And we don't pay for that. As you know, mobile companies, cellular companies, pay for that spectrum for that usage to the government. It's very reliable, low power. It's less than a mobile phone in terms of power. And actually, we've got self-forming, self-healing. So what happens? We are a mesh like a spider's web. If one route went down, it looks for an alternative route to carry the data. That's why we can offer 99.5%. Unlike cellular is point to point. So if that signal goes down, that cuts off that data flow. But our one, as I say, is self-forming, self-healing. Next one, please. So this slide here, we're more and more getting additional partners. So on the top of this slide, these are the end customers. These are the customers using the solutions and paying for that solution. So companies like Tata Power, you may have heard of, Adani, Reliance, just to name but some. Then in the middle and underneath are the companies that we go to market with. So we either go through a meter manufacturer to the likes of Tata Power, Reliance, or we go through a system integrator, like for instance IntelliSmart, or we go through mobile operator like Telefonica, or we go through what we're now seeing is EPCs, engineering, procurement, construction companies. These are companies with deep pockets who build infrastructure like motorways, airports. Give an example on here, the companies like Alphanar, companies like NCC, companies like Monte Carlo, Hindustan Power. These are all new companies that have come out of the woodwork, now realizing the opportunities they can see in the marketplace. And those meter manufacturers were connected with all of them in some form in some different parts of the world. Next slide, please. Now, I'll just hand you over to Heather, who will take you through some of the numbers, the latest numbers.
Hi, everybody, and thanks for joining, and thanks for showing the interest in Cyanode. So I'm just going to talk about giving an update on the numbers for the results that we announced just last month for the financial year ended 31st of March this year. You can see from this, and you can see from the graph as well, how the company is growing. Revenue increased up to 9.6 million from 6.4 the year before. And if you consider that the previous year before that was 2.5, you can see how this has
been growing substantially year on year. This was all driven by a record number of modules that were shipped. Many of you who know our technology and our business model will know that we sell modules, gateways, services, head-end software, and support and maintenance. So the initial part of a contract, once we roll out a contract, the contracts run over typically anything up to 10 years. And the initial phase will be us shipping the modules so that the modules can go out into the field. Well, first of all, they get integrated into the meters and then they get installed out in the field. So the initial part is the modules, and we shipped 612,000 versus 481,000 the year before. 62% reduction in operating loss to 1 million compared to 2.7 million operating loss the previous year. And once again, you know, on the graph, this is showing how we're moving towards profitability. And in fact, actually, our adjusted EBITDA was positive by 100,000 for the financial year versus a loss of 1.9 million the previous year. Cash and cash equivalents increased to 2.4 million at the end of the financial year. So next slide, please. This slide just shows the graph of the modules and how it sort of ramped up in the second half of the year. The first half of the year, if you remember that this is 2021, so from April to July 2021, in particular, India was hit really badly with the second wave of COVID and was in a really sort of severe lockdown. So that's why shipping was quite low, and then it took up the second half of the year. So next slide, please. And then talking about post-period end, just some key things that have happened since the end of the year. If I sort of summarize, to the 31st of March this year, from all the time that we've been working in India, in other words, you know, we started about 10 years ago working in India, and in all the time from then until the end of March this year, we'd won 1.3 million units. And since the end of March, we've won a further 1.3 million. So you can see once again how things are ramping up. The tenders that we're seeing, as John mentioned earlier, the tenders that we're seeing at the moment are tenders in the millions, whereas a year ago, they were in the hundreds of thousands, and prior to that, they were sort of tens of thousands. So you can really see how the market is starting to take off. So there was a 1 million unit order from Genus, and then 2 orders from IntelliSmart, totaling up 300,000 modules. Interesting thing about the one from Genus, with this one, because they're a meter manufacturer for this particular contract, we've agreed that they would actually also manufacture our modules. So it's quite a good model for us from a working capital point of view, because they will buy the components, they'll put everything into manufacture, they sell to us, and then we sell on to another division of Genus. And obviously the cash flow sort of just passes through from one part through us to the other. We've also, since the end of the period, we've won 2 orders in Middle East, North Africa region, and those are worth just over $9 million. And good thing from a working capital point of view with those ones is that we receive cash all paid up front before we actually ship anything. So 50% when they sort of call off a number of items to be delivered, and the remaining 50% before we actually ship. Since the end of March, and this goes to the end of August, we'd received 3.7 million cash from customers. And we are integrating with a number of, with 9 extra meter manufacturers. So this gives us additional routes to market as the market grows, and the Indian government obviously wants many more manufacturers to, you know, to de-risk, and that's why it's good for us to be integrated with as many as possible. We've had a change in the business models, which is a requirement from the standard bidding document for the AMI SPs using the DB foot model. And with that, there will be an element, usually about 60% of the contract will be CapEx as we install, and then the remaining 40% will be equal monthly installments spread over anything up to sort of 8 years. And as I say, that in the last point, you can see that, so it's sort of 60%, and then we spread the remaining 40%. So next slide, please. And I'll hand back to John.
Yeah, sorry about that, just having finger trouble. I think just for time wise, I've talked about the first part of this, where we're doing 41 million tenders. Next year, we're expecting 109 million. So 150 million smart meters are out there for right now out of the 250 million that will be tendered for in the next 18 months, which is fabulous. And, you know, what are the government doing about the encouragement here? They're encouraging the government outlay of over 30 billion pounds sterling to roll out smart metering. Of that, they're actually rolling out for grant money 10 billion pounds sterling, which is given to each utility between 15 and 22% of each project to help fund the rollout of smart metering. The reason that they're doing all of this is to make the discoms profitable, because what they want to do in the long term is move from analog network to a digital network, make them profitable, and then what they want to do is privatize those discoms as we have done in the UK. Next slide, please. This just gives you an idea of across the width and breadth of India, where we've deployed to date the 1 million units across India. The next one, please. And this just shows what else I've already said, that other parts of the world that we're operating in. You know, we've been operating in Thailand for some time, and that's going really well, and we're expecting some good future orders coming out of there, as well as UAE, both Dubai and Abu Dhabi, and also looking at other opportunities, not just electricity metering. Next slide. Well, thank you very much for listening. Now I hand you back to Hardman.
I think Richard is keep
I'm here. Sorry, I'm here. Sorry, I just clicked on the wrong link. Can you see me now?
Yep, that's fine, Richard. Off you go.
Right. Okay, so I'm going to start with the longest question first. Apart from what we've just been talking about, there have been other global successes for side node solutions over the past few years. Can you comment on any other product solution areas such as smart gas, smart water, smart street lighting, and EV opportunities that may be of interest to investors and potentially available for solutions in the future?
Yeah, sure. So, you know, we do have, you know, opportunities that we're looking at, as I mentioned, funny enough, on the last slide there. We are looking at, you know, water metering, for instance. You know, we've also got opportunities, and actually, part of the deal in the UAE, well, I should say Abu Dhabi in particular, is hooking up existing meters that are electricity and actually water. So we're already doing some of those other opportunities. But as I mentioned, Richard, the real opportunity right now is on electricity metering, and that's why we're very focused within India.
Okay, so the next question is, given the competitive nature of the Indian market you've described, how do you forecast your activity in the area given those competitive pressures? How confident are you that you will reach your internal targets?
Yeah, so I mean, to be honest, we always like to sort of, if you look at our numbers in the last 3 years, we've actually overachieved our actually numbers to the marketplace, which has been great. And the difficulty is, because of the speed now this is happening, so for us to say, you know, out of the 41 million, pinpointing how many will come to sign Canode for pure RF mesh, you know, it is a difficult science. Why we'd like to say that the numbers that we've seen the analysts put out, not us, but the analysts have put out, are probably cautious, but that's a good thing, because we don't want to put numbers out that we miss. I mean, we want to make sure we can hit the numbers. And, you know, we do see, well, which is encouraging, you know, we do see other competitors coming in particular, the actual people that are our customers. As I mentioned, EPC, engineering, procurement, construction companies are out there in the marketplace, you know, and they're there because they know they can run 8 to 10 year contracts and fund them.
Right. So the next question relates to your financial situation and the strength of your balance sheet to enable you to reach these growth objectives. Could you explain how you are going to do this? So can you start with the balance sheet and then tell us how the company will grow?
Well, I think that a couple of key things that I mentioned on, when I was talking through the financials is that with this largest order, which is our largest order to date, the 1.4 million units from Genus, just by using them as our manufacturer as well as our customer will help working capital. And from the UAE, those contracts, we're getting the cash in advance. So those are some of the key things that we're doing to get us through this sort of stage as we grow. And I think also the fact that we have the 60%, which is CapEx, and the CapEx comes in as we ship modules, and we use letters of credit for that. And we get the letters of credit discounted, so we receive the cash for that within, maximum 30 days when we ship the hardware. So all of these are things that we've done to help with managing the cash flows, and we'll continue to do that. And obviously, we'll watch things as we continue to grow, depending on how many units we actually win. As John said, it's a difficult science sort of predicting how many we're going to win. And the other difficult thing is obviously predicting the timing of when these things will come through. But at this stage, the model that we've been working on and using seems to be working, so we'll continue to use that.
Thank you. So the next question is, the Middle East is fast becoming a significant source of revenue for the company. How do you think, what do you think about the evolution of the geographic revenue mix over the next 5 to 10 years? So if you can look a little bit further forward, how do you think the company will balance its opportunities between now and 2027, 28?
Well, I think if you consider the size of the Indian market on its own, and if we look at, for example, last year, India probably made up about close to 90% of the revenue. This year, it's going to be a slightly different mix. But because of the size of the Indian market and the sort of speed of these tenders that are coming through, I would expect India still to be the largest share of our revenue over the, not just the next 2 to 3 years. I would think sort of continuing until the 250 million really are rolled out. I mean, we are, as John said, we're in the UAE, we are in Thailand as well. But if I look at the size of the Indian opportunity and the size of the tenders coming through on that at the moment, I think that we're still going to see that India is going to be the largest part of the business.
Okay, thank you. So the next question is there a natural life cycle to the meter program? In other words, are the meters going to be obsoleted and replaced, or how many years will they basically last for once they're in place? Is this a repeat market? I think that's the question. Or is it a one-off market? Once you've done it, you move to another area.
Sure. So if you think of, of the UK meters, those meters were around for about 30 years, made of metal, and you remember the old dial that whirl around. Well, these days, like everything, in the world, they're made of plastic, and to be honest, the people in the industry are saying that it's probably about a 15-year cycle for those meters to last in terms of ensuring that they are accurate and sending out the correct meter reading. And therefore, the physical meter will need replacing. Now, remember, what we've got is ongoing support and maintenance. Heather mentioned 40% month on month, equal monthly installments for 8 to 10 years. Well, actually, it doesn't stop then, because if they stop, that meter goes back from a smart meter to a dumb meter. So why put all that investment in? So what will happen? They'll come back to us and renegotiate for the next 10 years. I mean, ironically, in the UK, we've got a 15-year contract, which is great for the support and maintenance. And, when we look at, for instance, Tata Power had a 5-year contract. What happened? They came to us last year and renegotiated another 5. So we'll just see, Richard, a continuation of the ongoing revenue stream. And then, of course, remember, when we just sell into a utility, we might be selling 1 million units now into a utility. That utility may have 20 million meters. So they'll come out again with another tender, and it's going to take a long time, let's face it, 250 million. I know they're saying 5 years, but that's a lot of meters to go at.
Absolutely. So the next question relates to, I think, a common issue in the world at the moment, in the electronics world, is supply chain issues. Are there any supply chain issues in components in order to allow you to meet your production goals?
I think these supply chain issues and delays have been going on since about 2020, which actually is the time that we started ramping up in our supplies towards the back end, about October 2020. And lead times grew longer and longer. And we've got a very good relationship with our main provider, the provider of silicon. And we've got an arrangement with them where we've got to sort of give forecasts for 12 months in advance because their lead times are 12 months, but they do allow a little bit of flexibility in that. So we obviously look at that and we plan, what's the maximum that we think we're going to use, because they allow us that flexibility. And in the sort of month or two before before they're due to ship it, we can potentially shift it out if we think that we won't need it straight away. So we do have that flexibility. We've even managed to negotiate a good, price reduction on that as well, due to our relationship with them. Some of the other, there have been some tricky parts over the years, but we've been managing where in certain cases, if we can't get it from one supplier, that silicon is the key component that we can only really get from one supplier. So that's why we've been so specific about how we manage it. Some of the other components aren't necessarily only available from one supplier. So, what might have happened is we might have, to be able to get something, if we haven't got it through the regular supplier, we might have had to go somewhere else. Sometimes we might have had to pay a bit more, but generally we've managed to do that. And as you can see, we've managed to deliver. So, once again, I think we're managing those relationships well.
Thank you. So we're going to go to a poll in a couple of minutes or so, and I'll talk a little bit more about that when we get there. But in the interim, if anybody has any last minute questions, please submit them. We've had one other question from an investor who says, what are the key metrics I should be looking for in deciding how to value the business? Well, maybe you would like to answer that from your point of view about how you look at the financial metrics in order to decide how to grow the business.
Yeah, thanks, Richard. Good question. And we have analysts who look at our market, and I would look at personally, I would look at the value today of the market cap of the company. Use discounted cash flows as a particular way of valuing a company. But I think in our case, people have got to look really of where we are. The investment that we've done of $50 million on the product for India and for the rest of the world, but mainly for India. You look at our positioning, we've got 60 people in India that's all local. And, we have got excellent companies that we go through, like Schneider that I mentioned, Adani, Reliance, etc. Why are they all buying from us? And I think if you look at going forward, and it's actually trying to give a value for the going forward opportunity, as I mentioned, 150 million meters to go at in the next 18 months. You can't say to me that we're not going to win any of those. We would expect to win a good portion of those. And I think that gives us the value in terms of where we are with revenue and EBITDA and the multiplier that we get. And these are long-term contracts. So these are EMIs, reoccurring revenue streams that will go on for 8, 10, 20 years, etc. once the whole thing is installed, which is going to take some time anyway. To install all of those, you're probably talking about 8 years to install 250 million, to be honest. And then there's all the rolling out. So, I'll leave it to the experts about the valuation, but I know certainly that I'm not that happy where it is personally, but that's where it is.
Well, John and Heather, thank you very much indeed for a fantastic presentation. For the audience, we're now going to go into the poll. You will need to scroll down through this poll, and when you get to the bottom, could you please press the send button to complete the poll? And I'm now handing back to Keith.
Richard, thank you very much for that. Yes, so we encourage people to fill in the poll. All this sort of feedback is really useful for the companies. Thank you also for your questions, and a reminder, there's a button called Ask a Question if you want to ask a question of the following companies. I'll start telling you about the next company whilst the poll continues to run. So our next company today is Blackbird. Blackbird provides a video editing and publication platform, and it solves the problem of editing content in the cloud. From a customer's point of view, it brings you a combination of three good things. One is efficiency in your editing. Second is sustainability. And the third point is low total cost of ownership. You've got a slide up there giving you some of the numbers here. So it's got a market cap of 55 million. It's an AIM listed business. And here's there's also on the left-hand side there, you'll see some pretty well-known institutional investors are large holders in this company. And that gives me the opportunity to say thank you for filling in the poll. And let's go to Ian McDonough, who's the CEO of Blackbird. Ian.
Good afternoon, ladies and gentlemen. Thank you very much for joining today. So I'm going to take you through a short presentation on Blackbird PLC. I'm going to cover off what we do, who we are, where we came from, some key highlights, and a walk through the strategy, and then I'm going to conclude. So next slide, please. So what Blackbird is and what we do, we're an AIM-listed business. We have a market cap of around 55 million at the moment. We've just done our interim results, so we've had a presentation fairly fresh for this presentation for this audience today. And what we are, we're a cloud-native content creation and distribution platform. So that means that we can do video editing and we can do video publishing. And that is for the professional markets. That is for the professional global media and entertainment market. So customers that we have on our client list, for instance, include such eminent people as the NHL, the NFL, the US State Department, CBS Sports, A&E Networks, really the top end A-list clientele of the US media market. And most of our revenue is coming from the US. We are also very efficient as a platform. We are very carbon efficient. We are very cost efficient. We're very time efficient. We are very bandwidth efficient, hardware efficient, you name it. The way that the software has been architected means that we will run on very low amount of resources. And that is useful to customers. Why? Because we are used generally as a remote tool. So they will use us for remote editing from the field or from outside of the office, or sometimes from other offices across their networks. So generally we're very easy to plug in, very easy to operate, and very, very cost efficient to run. Now, at the core of Blackbird, and I know I'm going to get this question later on, is how we value the business. Well, right at the core of our platform, we have a very large amount of patents. We have 15 patents locked in and 5 more pending. We're aiming to grow that as well going forward. And those patents are based around how we treat video in the cloud, how we treat video on the internet. We have a very, very lightweight, efficient way of accessing high quality video and editing it frame accurately and then publishing it. And we are the only people in the world that can do what we do. We are growing our customer base very rapidly and getting a real name for ourselves in doing this. Obviously, before COVID, this was something of a rare ask, and we were building into a market that was growing relatively slowly. But since COVID has kicked off and remote editing has become really the norm, this market has really mushroomed. So in terms of awards as well, we're a multi-award winning platform. We have just won in December last year the Environmental Sustainability Award of the Year from IABM, but we're also holders currently of the Best Tech Company, and we're also holders of the Queen's Award, which was awarded to us just a few weeks ago. We're also the NAB Product of the Year at this stage. So we're well renowned, well understood within our marketplace. Next question, please. Next slide, please. So as I say, we just done our half-year results, and we're going into the second half after having record revenues and record growth. We're up 78% versus prior year. We also have a record order book at the end of August of £4 million, and so it was record growth. We've also just done a fundraise in December 2021, very well timed, as I'm sure most people on this call will attest to raise money to accelerate growth opportunities for ourselves in the creator economy. So outside of professional M&E, professional media and entertainment, the software, the technology has a huge amount of application within the creator space. And by creator space, what we mean is anybody that is trying to make money from creating video. So yes, that means all of those influencers, it means all of those YouTubers, it means all of those people that are in the social space. But also beyond that, there's also the prosumer market and the corporate market as well. So it's not just the social space, it's beyond into the prosumer and the corporate space as well. We've also hired in-house expertise to accelerate growth opportunities. So we've hired in 3 leaders into the business since the last few weeks. This was on the back of the fundraise. They are a chief product officer, whose name is Sumit Rai. Sumit has been a leader in the business himself. He was chief product officer at Vegas, which is the 4th largest video editing platform in the world. We've managed to find a tech expert of that caliber in the UK, which is amazing, and brought him over. We've also hired a new VP of engineering and a new VP of product marketing. So we are really moving very quickly into that business, to that direct to consumer, direct to customer space with the new team that we're bringing on. We've also, and I think this is really important, because the company is in the past focused really on direct deals in the media entertainment space. Scaling that business has been a kind of one-by-one opportunity, and we wanted to make sure we found a way to scale things a little quicker. So we've done this last September, our first technology licensing deal. That means that the core technology that powers Blackbird is now powering a partner of ours, it's a European partner, who is rolling out their platform to an A-list gold standard broadcaster in the US. And this is just the first customer of many. So this is a real inflection point in terms of scale for us. But before we've been doing one-to-one deals, as I say, and now this partner will allow us to scale our technology very quickly across the entire industry. So this company in question has over 500 installs, 500 customers installed across their base, and we are very confident that Blackbird will be penetrating into a large number of those. So real inflection point in terms of for us. Okay, next slide, please. So this slide is kind of encapsulates what I've just been talking about in terms of where we're going strategically. So when I joined the company back in 2018, we were working really just purely on infrastructure deals, where we were doing one-to-one deals with the likes of the US State Department or CBS, etc. And they really do still, we do a lot of it direct deals still, because they're very good for our pedigree, they're very good for our press, they're very good for our reputation in the industry. But where we're going to scale, how we're scaling Blackbird, is really through the next 2 circles here on the slide. So OEM, which is the technology licensing side of the business. So as I mentioned, we just done our very first powered by Blackbird, so our first technology licensing deal into this European partner, who's now rolling out that product across its customer base. So that's a way to see the penetration through the media and entertainment sector. And then what we call here is public cloud is the larger circle on the right-hand side. Public cloud here is a vector. It's a way to reach a mass market. By public cloud, we're talking about the big clouds like AWS, Microsoft Azure, or Google Cloud Platform. And once we have our own cloud natively programmed into the public cloud, we can release a software, we say high availability SaaS platform that will allow us to penetrate the creator space. So the creator space currently is a $100 billion market. It is really the preserve of 4 major platforms: YouTube, the Meta platforms, TikTok, and a number of others. But it is those. Well, it's Facebook and Instagram, TikTok and YouTube. They're the ones that kind of currently run that market. We can provide a content creation and distribution tool that will address that market ecosystem. So very exciting. This is the next stage of our growth, and this is going to be happening in the next 12 months. We expect to have a product in the market in 2023 to address that market. Next slide, please. Now, this presentation was really about ESG, and one of the key reasons why Blackbird has such cachet in the market is really because we are the most carbon efficient platform out there. We are carbon efficient for a number of reasons. Firstly, because we allow almost 100% remote editing, so therefore there is no need to travel to a venue. So in the media entertainment space, I don't know if anyone here has been to those big sporting events, but you'll remember there are always big trucks out there outside of those big sporting events. Well, we negate the need for producers and for editors to travel to the venue. They can do that from their home base. We also have a much lower impact in terms of machinery, in terms of hardware. So you can use Blackbird on any hardware, on any laptop. You don't have to have a specific piece of hardware built like our competition. And most importantly, we have a massive saving in terms of bandwidth. Because of the codec that I mentioned very much at the top of this presentation is so efficient, it means that you're not shunting, you're not transporting high res video content from A to B and B to C and back again. And that is a huge drain. If you're moving that high res content, and we're not talking just about HD content, but we're talking about 4K and very soon 8K content being moved around, it is a massive drain in terms of carbon and in terms of cost. Because we're not doing that, Blackbird has been seen to be up to 91% more carbon efficient, use less carbon than our competition. So we are 91% more carbon efficient than on-premise system, and we are 84% more carbon efficient than a cloud-based system. So a cloud-based system has gone kind of halfway there. It is remote, but it is a kind of lift and shift solution whereby that high res is still being moved from A to B and around the world. So that is a little snapshot of where we are with Blackbird. Blackbird, as I say, it's just come off it is currently in a huge growth trajectory in terms of revenue. We are 78% up in revenue up to the half year. We have a record order book. We have an inflection point in scale just about to happen as we roll out to this gold standard broadcaster across the US and the partner in question's customers beyond that. So the partner in question, it doesn't just deal with this US broadcaster. They have customers in sports and news in most countries around the world. So we're really at an exciting point in terms of the growth of Blackbird into the M&E market. And then just to conclude, we really want to enter the creator space, which is a $100 billion market today, where the scalability of our platform, the ease of use and the efficiency will allow us to penetrate deeply. I think some areas of context here as well, just before I finish, is that this is an industry that is populated with giants, and we are very friendly with all those giants. So we're working closely with Amazon, we're working closely with Microsoft. In fact, we were just on Microsoft's stand at the last IBC show in Amsterdam just about 2 weeks ago. We were on Google stand at the last IBC show, and we're working very closely with Amazon. I think one of the things just to note in terms of movement in this industry is it is a very acquisitive industry. So there's been some major transactions happened in this industry in the last few years. There's a company called Frame.io that got acquired by Adobe about a year ago for $1.25 billion, which didn't do the same thing as Blackbird did, but did something adjacent. And then just to make sure that there's still life in that market, Adobe acquired a company called Figma for the grand sum of $20 billion just about 3 or 4 weeks ago, as we were on this roadshow actually. So it just shows you that there's an awful lot of interest in companies that can get the product right and get the formula right to roll out a very scalable platform. So that's my conclusion. Thank you very much.
Ian, thank you very much. Right, there's a number of questions. I'll go through them in no particular order. The first question relates to the success of companies in the COVID and working from home world, where a lot of companies have picked up massive revenue growth and found latterly that there has been an issue. I suspect the question's sort of based around what's happened to Peloton and Deliveroo and all these other sort of companies. You obviously don't believe that that's going to impact your company to the same extent. And in fact, what you've talked to us about is a massive increase in your growth. So just to allay investors' fears, why do you think you're not going to have the issues that so many companies have had when we're recovering from COVID?
It's a good question, and what we would say in terms of production is that the technology has been obviously available in the market for some time to remotely produce, but there's been a lack of confidence, a lack of need to do that, up until COVID, and then it was tried, and it was seen to be not just better in terms of health and safety, but actually it was better in terms of cost, it was better in terms of quality, it was better in terms of life balance for workers, it was better in terms of carbon. There was just a whole raft of different reasons why remote production was suddenly far superior to sending huge amounts of people, airplanes, trucks, whatever it be, to an event. And so on the back of that, I think it goes back to that kind of Elon Musk quote where he says, we don't just want to build a better electric car, we want to build a better car. And I think that's the whole thing. We want to build a better remote experience. We want the whole experience to be far better. So that's where we are today. I think the double-edged sword of that, of course, is that once you've proven that there's a market there, that there is always competitors that come into that market. So the market has grown enormously in terms of its size, and Blackbird is still very much a market leader. But the fundraise at the end of last year was really timely to bring on new team members and new expertise to make sure that we're pushing forward with our technology, pushing forward with our strategy to stay ahead of the curve.
So I think you mentioned the patents, the ones you've got and the ones that are pending. And this basically, to some extent, limits the technical competition. I think that's basically what you said. But how much money do you need to keep investing in the business to stay ahead of the competition? How much, in other words, how much R&D spending do you need? Because presumably this market isn't static, it's a tech market that's moving very rapidly. How do you address that issue to keep ahead?
Yeah, so I think the great thing about Blackbird is that an awful lot of that's been spent already, even before I came on board. So the company is not a brand new company. The company has been around since the year 2000, and what we have created in the Blackbird patents is not an easy thing to do. It's not an easy thing for us to do if we started from standing start now with 1,000 engineers. It's not that easy. In fact, I was at the IBC show just 2 weeks ago, and one of our competitors said that he was very tickled by the fact that because we renamed the company Blackbird in 2018, he was very tickled by the fact everyone was suddenly talking about this startup called Blackbird that had this amazingly reliable platform. In actual fact, it's taken a long time to build. So where our uniqueness is and where our competitive advantages are is strong at the moment. But to address your question, how much do we have to keep moving it forward? Well, we can't rest on our laurels, and we've increased the size of our engineering staff alongside the leaders that we said that we brought in, to make sure not only that we're making sure the codec is moving forward, and currently we're working with a codec called Blackbird 9, and we are hoping to release Blackbird 10 in 2023, so that's going to take us to a whole new level in terms of efficiency and quality of that codec, but also that we're moving the product forward, and the product is more polished, the product is more integratable into other different platforms, and it addresses a larger market. We want to make sure that we're going to be a full glass-to-glass solution for that creator economy market.
Could you say more about the pricing environment in order to gain business? Are you after market share, or are you after quality clients?
That's a great question. I would say we're still growing the company, so we have to be competitive. We have a superior product, but the superior product has to be, has to also be able to knock out the price comparisons as well. So we are very competitive against our competitors, the likes of Adobe and Avid, and others in the space. Where we are slightly different is that Blackbird actually offers a wider range of benefits or of services. So not only are we offering video editing and publishing, but we also offer bandwidth, we also offer cloud storage, we also offer compute power as well. So where our pricing compared to our competitors, because of the wider range of services that we offer, is around 10 times our competitors. But once you boil it down into like for like, it's pretty similar. But because we offer this wider range, we can get a wider share of wallet.
So when you win new business, are you largely replacing an existing supplier, or are you finding that companies realize that there's a great opportunity to use your product in order to reach further afield? So how fast is the market growing for new users relative to people already using this content, but using a different supplier, so to speak?
So in the creator space, the market is growing extremely quickly, and when we go into that market, we won't be replacing things. We'll be going into fresh users effectively. In the broadcast market is growing much more slowly, and we generally are there a replacement tool. What we've found though in large accounts such as A&E Networks, and unfortunately I'm never allowed to say the name of this company, but we're in the world's largest financial news organization. I'm sure all of your listeners and viewers will know this organization. Not allowed to say the name of it, but we in those two organizations, we actually added huge amounts of new competence to their team. So we've been put right across the base, and people from marketers to social media to legal, as well as content people, are using the platform to access and able to process video.
Thank you. Just remind people, if there are any more questions you'd like to post, we've only got about another 3 minutes. I'm going to move on to the next question, which relates to the public cloud you mentioned. I wasn't quite clear whether your reference to YouTube, Meta, and TikTok was meaning that you were able to help them grow their businesses, or whether you were helping other people compete with them.
Well, indirectly, we would help them grow their business. What we would do is allow their content creators to produce content more easily. So at the moment, to produce content outside of using a standard platform, so outside of using a TikTok editor, or outside of using an Instagram editor, the field is either very complex. You're either very complex up here in the kind of Adobe Premiere or the Avid area, which just is not really an option for your basic social media creator, or you're in the very, very, very low end tools. So there's nothing really that allows for very easy, scalable, high quality content creation and publication across multi-platform at this stage, and that's what we will be offering.
Okay, so we're going to move to a poll in a couple of minutes. It'll be appearing on the right-hand side of your screen. So the last question basically is your revenue is just about 2 million run rate at the moment. Just tell people how rapidly you think you can grow that over the next 5 years.
Well, we closed last year at 2 million. We are that's not including the interim numbers, so we're significantly up on that in terms of run rate already. What we'll be doing in terms of scaling our numbers, we'll be addressing this enormous market of the creator space, where, as I said, the likes of Figma and Frame before us have managed to scale very, very quickly through that market by getting the product right for a high availability SaaS platform. And that's where we're going next.
Okay, and the last question, there's just one come in. On these license deals, how do we know that you're not giving away too much of the pie just to expand the scale of your product?
Well, it's a market that keeps you very honed. This is not a new market. This is a market where there's big players, big giants in the market, and we're making our product as competitive as we can to grow. But we also we are shareholders in the business, so we want to make sure that shareholders are very well looked after. So we very much have that top of mind. So we make sure that we are keeping an eye on the prices and get the balance right.
Ian, thank you very much indeed. So now we're going to a poll. If you remember to scroll down as you go through the poll and then to press the send button, that would be much appreciated. Handing back to Keith. Thank you, Ian.
Richard and Ian, thank you very much indeed for that. Very interesting. Again, I encourage people to fill in the poll. The feedback's really valuable to the companies here. And thank you for the questions that are coming in as well. And please keep them coming in. Just click on that Ask a Question button. So we come now to the final company presenting today before we go to the panel session. And that company is Gore Street Energy Storage Fund. This is an investment fund which exclusively invests in, as the name suggests, energy storage assets. Put this into context, because solar and wind electricity generation can happen at all times of the day, and often at times when demand is low, there's a need to store that energy to be used later. At the moment, battery storage is one of the few ways of doing so. And what Gore Street provides you with is an investment in those sorts of assets in the US, Germany, Ireland, and the UK. It's particularly attractive as an investment to income buyers because the management are targeting a minimum of a 7p annual dividend. And as you'll see on the screen, the company or the fund has got a market capitalisation of just over £500 million. Pleased today to be joined by Alex O'Kennedy, who's the CEO and founder of Gore Street. Alex, over to you.
Thank you very much, Keith, and good afternoon, everybody. First, a word on myself and Gore Street. So, as Keith mentioned, I'm the founder and CEO. We founded the firm back in 2015. We were in action really in 2016. And my personal background is nearly 20 years investing private equity, majority spent investing in the world of renewables. And next slide, please. We founded the firm as we wanted to make a material difference in our transition to a low carbon economy, which is a very big tagline and one that required us to narrow down. So as the manager, taking the range of experience that myself and my partners had in terms of investing renewables at scale in solar and wind, we determined that energy storage would be a fruitful area for us to help build our franchise. Next slide, please. So what have we been trying to do with Gore Street Energy Storage Fund? We're very proud of the development of this vehicle. We IPO'd the Energy Storage Fund in May 2018. We invented this asset class for the public investor. And through this vehicle, we aim to have certain characteristics we aim to deliver for our investors. We want to be the market leader. It would be very surprising if you heard a presentation from anybody in our business that said otherwise. We're one of the main players in the British market in terms of storage. We're probably the #1 player in the Irish market, and we've recently entered the German market and the North American market. We've been investing in energy storage since 2017, and so built up a very considerable portfolio, which I will take you through in a few slides. That portfolio we run to deliver a diversified set of income, a diversified portfolio. So we're active in multiple jurisdictions, but we're also in each of our assets in those jurisdictions, we're able to do multiple types of revenue activities. Our entire fleet is lithium ion. We work with some of the largest manufacturers in the world who build our assets for us. And so we have a very strong, proven technology and operational background that allows us to run these assets at a very high level of availability in very complex situations. We, as Keith mentioned, we aim to deliver a very good income to our investors. We underwrite our assets to a 10% unlevered. So we look to deliver a 10% IRR on the assets that we build and then own. And then From that, we deliver a 7p or 7% of NAV annual dividend. We're very proud of our performance. Overall, we delivered 13% to our investors last year, and the year before that, just over 14%. So very strong outperforming against our baseline underwriting. This session is around ESG, so I'm going to talk a few slides around how that becomes very important to the firm and to the performance of the firm in the later slides. Next slide, please. So this is a snapshot of our portfolio. As I mentioned, we've been active in the GB market since 2017, in the Irish market since 2019, and earlier this year, the German market and the North American market. Taking a step back, what's the driver of the growth of this portfolio? What's the driver of these assets being a critical part of our energy transition? Keith mentioned it. We've in the process of a large build out of solar and wind across the world. Solar and wind are excellent generation sources, and in many of the markets, increasingly, nearly all of them, they are competitive or cheaper than the fossil fuel equivalent. That excellent generation source, though, does come with some complexities. One of the biggest complexities is they are intermittent. So the sun will shine and the wind will blow when those two things decided to do that. And though over medium term, over months, over years, you can track and you have very good visibility of how much electricity solar and wind will deliver for you, on a minute by minute, second by second, it's very hard to understand exactly how much you will have. That growth of renewable power is also matched by decommissioning of coal, gas, and nuclear. And so the energy systems across Western Europe and North America have this large transition where the grid operators used to have very good visibility of how much power they would produce second by second, as well as have very good visibility of how much power was needed. That's changed, and that change is for the benefit of society by replacing these highly pollutant forms of electricity, coal and gas, with renewables, but comes with that complexity. Storage fills that gap. Our assets throughout GB, as we can see here, and throughout Ireland, and then clustered in North America around Texas, provide stability to the grid. They allow the grid to be balanced, to balance off renewable energy power and baseload power on a second by second basis. Overall, we like to say that our assets are a stabilization assets. We are long volatility on the energy system. The more volatile the energy system, the more our assets accrue value. Next slide, please. Turning to ESG, I think it's really interesting. This session has been really interesting, where we have three, I think, very different companies all approaching the investment thesis with the context of ESG. ESG has always been important to us in Gore Street. We founded the firm on the basis that we wanted to do good. We wanted to be a materially positive player in our energy transition. I think it's all very well saying that. It does require a lot of effort, and we as a firm have spent more and more human resources, more and more money resources in terms of being able to deliver for our investors a very good picture of what we are doing in ESG. ESG, three breakdowns. So environmental, we feel very confident that our assets are benefiting the environment. Without our assets functioning well, more renewables cannot get built on the grid. That is, in essence, the underlying premise here. Storage enables renewables to function well and more renewables to get built. So our asset base is allowing more and more renewables to come on the grid, and therefore less and less pollutant baseload power. There's also obviously other aspects of ESG. Social is a very important aspect. Social not only in our communities that we have assets, but also social within the company itself. We are very focused as a young progressive firm in terms of understanding how we bring multiple different backgrounds to bear on the investment problems that we face. And we're very proud of the mix of our colleagues in the firm coming from a range of different backgrounds and a very healthy mix, we believe, adds to the investment profitability. And then finally, governance. We are committed to greater data capture. We want to be at the leading edge of disclosure, and therefore we're working with multiple agencies to be able to get our investors the information they require in the format that they need. Just a picture, a few moments then on the picture below. This is one of our assets. It is indeed shipping containers. These shipping containers do contain very high levels of energy storage, lithium-ion battery cells, wrapped with some very significant technology, connected to the grid and providing a critical service to that energy system. Next slide, please. Talking about then the aspect I called out around social diversity and inclusion, I think these statistics are really quite different for what is in essence a private equity firm coming from very kind of traditional conservative background. Here, as you can see, we brought together a range of different backgrounds in terms of ethnicity, in the investment manager. We're also working very hard to build up a gender balanced firm. And we do these not just because they're the right thing to do, and indeed they are the right thing to do, but we do these because we are a better firm because of it, where we bring more different ways of thinking to complex investment problems for the benefit of our investors. Next slide, please. The ESG world is complex. There is a lot of frameworks. There's a lot of regulations coming through the EU, coming through the UK, coming from the UN. We have signed up to multiple of these, working with the Sustainable Development Goals, working with the SFDR, PRI, TCFD, lots of acronyms here, I'm afraid. But all of these are important methods and processes and reporting standards that our investors want to see, and we want to produce for our investors. We're also, of course, very proud the London Stock Exchange chose to give us the Green Economy mark, and it's something that we aim to live up to. Next slide, please. I wanted to finish on a case study. Here's another one of our assets. This is in Northern Ireland. Ireland is one grid, so one energy system. And our assets in Northern Ireland and the ones we're building in the Republic are providing this critical service. I've talked about it before, that without our assets, more and more renewables cannot get built. Without storage functioning correctly, we will have very serious problems in our grid, given the amount of intermittent power. Some of those problems leading to brownouts and blackouts. This Drumkey asset, commissioned over a year and a half ago, 50 megawatts, operating in what's called the DS3 contract. That is a contract through the grid operator, EirGrid, to provide balancing services to the grid, to make sure that the grid is balanced at all time with the various forms of generation coming onto it. Earlier in the year, late last year in November, there was a very serious imbalance in the grid due to a high level of wind and a low level of availability for some baseload power. And our assets kicking in to be able to provide that stability that continued to allow the grid to function as normal. So for us, as we sit here as investors and one of the largest investors globally into energy storage, we have a theme which is these are large assets supplied to us by very significant manufacturers with technology which is well grounded, providing a critical service to our energy system for which we are able to generate a very good return for our investors. So we feel very happy of the place we've ended up in the world of energy transition, and know that there's a large amount of work for us still to go, and we continue on a growth pattern, which, as Keith mentioned, our market cap is just over 500. We IPO'd in May 2018 at a modestly sized 30 million. So we've had very significant growth in the size of the investment trust, and we hope to see that continue in keeping with the growth of our market. Next slide. And next one. So overall, market outlook is very strong. Energy storage is recognized now as a critical part of our energy transition. It's outperformed against even our expectations from 2016, 2017, when we started looking at this market. The macro theme of climate change is not going away. So of course, there's going to be a continued growth of renewables. We would add in a macro trend around energy security now, which is more and more important, especially here in Europe, given the war. We as an investment manager, we're active managers. The diverse workforce that I mentioned earlier is focused on all the parts of the value chain in energy storage, from the origination of transactions, execution, construction, and asset management to the benefit of all our investors. We have built up a very large portfolio, multi-jurisdiction, with a large pipeline behind that, and we intend to execute against that pipeline over the coming time. As I mentioned, we've had strong financial performance, a 13.1% total return to investors last year, with the promise we made to investors around dividend of 7p or 7% of NAV continue to be adhered to. Thank you.
Thank you very much, Alex. So this is the last session. If anybody has any questions, would they please submit them as soon as possible? I'll go through these relatively quickly. They're probably very short answers, but I think it helps clarify questions in the audience mind. The first one, was there any particular reason why your share price was so weak at the end of last month? So over the last 12 months, the stock price is actually, compared with the markets, done incredibly well. But there was a little bit of a hiccup. So can you just explain what was going on there?
There was a little bit of hiccup last week, yes. I would say, without verging on politics, which I don't think would help anybody, I would say that if you looked at the overall renewable sector, which we are a kind of key part of, we have performed extremely well versus the rest of the market consistently over the last few years. Last week, there was a general perspective taken by the market that the risk-free rate had changed, that basically the Bank of England was moving up interest rates, and that the yield available on government debt was going up pretty heavily. We're not fully correlated to that, for sure, but there is definitely some correlation. So I think at the times of, really quite significant market turbulence, which we saw in the middle of last week, our stock price moved more than one would expect. The very reasonably large asset portfolio producing very strong income to do so. But I think it is a factor of the turbulence in that market, underpinned by what was some pretty difficult political activities. I think today we look at our share price, we've recovered into the 112, 114 range.
Okay, so let's move on to a more of a technical question. You've adopted the lithium-ion technology. What is the danger of it being superseded by battery technology development?
So we're all in favor of new technologies coming on stream that we can purchase and build for our assets. We look at things in two ways. One, we underwrite our assets to a declining revenue stream. So we believe our assets will make less and less money going forward. We're making most of our cash in the early years of the asset and then a declining revenue stream. Why do we underwrite to that? Because we assume that there will be cheaper technology put on the grid and will compete with our assets in the future. So we underwrite to that declining revenue. We think that is the appropriate thing to do. I would say we have been wrong on that over the last 2 years, as our assets have made more money, given grid connections are hard and supply chain is hard for some of the other players. The second thing I would say is we will add cheaper and cheaper technology to our portfolio, therefore lowering the overall cost of our portfolio. So there's an asset strategy, which is appropriate underwriting, declining revenue streams over the medium to long term, and there's a portfolio strategy of course, capturing better and cheaper technology for the benefit of the overall portfolio.
Okay, thank you. So some more specific questions now. Why do your Northern Ireland plants earn considerably more per megawatt than those in the rest of the UK?
It's not. I don't think they're. I think they're quite similar revenues. They are different systems, though, right? So as I mentioned before, Ireland is one energy system. So the Northern Ireland Republic, the grid operator EirGrid, which is owned by the Irish government, has a different contract type than the national grid, which is the grid operator of England, Scotland, and Wales. So they're operating in different markets and some different characteristics. Overall, both markets for us are delivering above our base case in terms of 10% unlevered. We, as an investment manager, I think quite uniquely, have made the decision that we want diversification in our portfolio between multiple markets. So we started in GB, we moved into the Irish market, we moved into the German market, and now North America. Our assets do more or less the same thing in all of those markets, and they're supplied by the same supply chain, but they do it in different flavors with some different pricing points. So it's not necessarily apples to apples, but from an IRR and return perspective, we're very happy that they're all overachieving against our base case.
Could you say more about your expansion in Germany and what the potential is?
Yeah, it's interesting. Mainland Europe has always been this quite slower development on energy storage. Energy storage, if I take a step back, I mentioned earlier that we are investors, we're long volatility of the energy system. If you have an energy system which is an island system, such as GB, such as Ireland, you have more volatility than if you are connected to a range of other grids, such as France and Germany, which are connected together. So they had better ways to balance their overall grid than, for instance, GB did, or Ireland, or in fact, North America. For instance, Texas is one grid, California is one grid with limited connections to the rest. So that has held back the development of storage a little bit in mainland Europe, but that has changed now. It has changed quite dramatically, of course, since March. In the geopolitical sense, the build out of renewables in Germany is really quite staggering how fast they are now approaching it, and energy security is also, of course, top of their attention. So we imagine that market will continue to accelerate. We were very happy to enter that market with a purchase of an operational asset from Enel. It well positions us in that market to understand how to make the right amount of money and to build the relationships there. So I think we're very happy to have entered at the time we did. We did it before the geopolitical event, and we are now well situated to be able to expand our footprint.
Okay, so the next question relates to the growth in EBITDA. How strongly do you expect your overall EBITDA to grow over the next 3 to 5 years, and why?
So obviously we're focused on growth here. We don't give out projections on EBITDA, but what I would say is that, coming back to some of the things I mentioned earlier, we underwrite our assets to a declining revenue stream over the medium to long term. We think that's appropriate given new players will come into the market. We have been wrong about that on the upside, because we benefited very heavily as the incumbent from other new players having difficulties getting grid connections or navigating the supply chain. We have very strong pipeline, very strong relationships with the manufacturers. So for us, as one of the incumbents, we don't really have, I think, the same problems other players do. So as I look at our pipeline, our published pipeline is about 1.3 gigawatts. That's about a £600 million investment target for the investment trust across multiple jurisdictions. We aim to execute on that at the present prices we see in GB market, in the Texas market, and in Ireland. We're generating very strong revenues, and we aim to have more assets to continue to generate more of those revenues.
Okay, so we're going to go to another poll in a couple of minutes or so. So if you have any more questions, please submit them. And the next question relates to, why do you formally link your dividend policy to movements in NAV when NAV can be unpredictable?
So we believe that we are on an upward trajectory on NAV. If you look at our NAV over the last few years, it's incremental growth every quarter, incremental growth driven by assets coming out of construction into operation, and continued strong delivery on our promise to investors in terms of the revenue per megawatt. So NAV continues to perform well. We wanted to be able to have a progressive aspect to the dividends. We wanted to reward our investors as as the value continues. But we do have a floor. We have a floor of 7p, and then we have upside as NAV on NAV. So we think, especially in today's environment, that a progressive aspect to the dividend is appropriate.
Okay, so this is the last question, unless there are any more that have just come in. When do you expect material revenues to accrue from the Republic of Ireland capacity?
We have assets which have already just been energized actually in the Republic, and are going through testing. And so those assets will be generating revenue for us over the next financial year. We have pretty strong expansion plans there, taking us over the next 1 to 3 years, with 2 of our sites having strong expansion in terms of megawatts. So already energized one of our facilities will start generating revenue for us very soon, and then multiple more megawatts in expansion to over the next 1 to 3 years.
Okay, well, thank you very much indeed. We're now going to go to another poll, which will appear on the right-hand side of your screen. So for the audience, if you could scroll down and then press send when you've completed the poll. Alex, if you'd just like to stay on the screen, and the other participants, please come back on screen. And in a minute or so, we'll move on to today's panel discussion. Thank you very much indeed. Right, thank you very much. I think we've got everybody on screen now. So what we're going to be doing is moving to a short panel discussion on sustainability and its impact on shareholder value. This is an open debate with the companies presenting today. So if you'd like, as well as a panelist, to explore, expand, or jump in on any of the comments and questions and discussion that we're about to enter, then please feel free to do so. We'll also take any questions from the audience a little bit later, and I think we should basically get on with this. So basically, shareholder expectations are increasingly focused on compliance and transparency and accountability for environmental and social issues, and that's probably true of customers as well. So as a result, we've seen management teams shift their sustainability agendas from purely side notes to an integral part of their overall strategy. But where does this leave shareholder returns? So we're here to find out today from the management teams how they've been making their decisions daily. And I think probably we'll start with a very general question. And then what I'd like to do is move the discussion into how you as companies are addressing the sustainability issues and challenges of today. And then later on, we'll talk about how you communicate those, what you're doing to shareholders. So the shareholders have got a very clear idea of exactly how you are essentially managing their money, but in a sustainable manner. So Heather, why don't we start with you? Do you believe sustainability initiatives improve shareholder value? And if so, in what sense?
Well, I think absolutely they do. I think by having a proper sort of framework in place with regard to, sustainability, ESG, the whole ESG, I think if you consider the environment, from us as a company, we obviously, our technology helps, problems with the environment. That's why we've received the London Stock Exchange Green Economy mark. But I think even just having a framework in place where you can almost, with having these processes in place, you can help to future-proof the business, and I think that's where it improves shareholder value. Shareholders, I think, if they know that you've got proper compliance, governance processes in place, it probably feels like a sort of a safer place to invest their money. Because, as I say, with regard to sort of future-proofing, if you consider recent events over time, even, for example, COVID, I think companies who had proper governance structures in place, proper procedures in place, could cope a lot better when COVID actually hit. And, you know, we are ISO accredited, so we ISO accredited for 9001, also 14001, which is the environmental ISO, and then 27001, which covers IT security and things like that. But I think even just 9001, we have our risk register, where as a company, we've got to consider what risks might hit us as a company and what we as a board are doing to mitigate against those. And I think that all of that just, you know, ultimately in the long run will help. You know, these sort of processes also prevent things like fraud and all sorts of issues that I think could be negative from a shareholder point of view.
Okay, thank you very much. So Ian, obviously a very different business from John and Heather's, but how would you answer the same question, which is essentially, how do these initiatives improve shareholder value? You're on mute.
That was the best bit I just did then. Okay, so I'll do it again now. So the key thing we're trying to find in our industry is data, and I think that any shareholder return at this stage is going to be beholden to making sure that data that's provided is accurate. Where we are currently in our industry, we're the only company that's actually put out a meaningful data measurement of our footprint and of the impact on our environment, and that's only within what we actually do ourselves. So with the scope 3 impact, as in how we help reduce the impacts for our customers, is extremely difficult to measure. However, we know it's going to come, and we know that the company that actually succeeds in understanding how that data is easily collected and measured and compared across the platforms is going to be very successful. We need to make sure that we're not just a part of the story, we're not just towing the line, but actually that we're leading on it, and that actually we're a very key voice in making sure that movement happens sooner rather than later. So how does it impact shareholder return at the moment? I would say for Blackbird, it's still not the key thing that people look at Blackbird for. What they look at us for our scale and how we're going to take over a huge market. But as time goes on and this data becomes available, it's going to be so important. So yeah, we're very happy to be the leading in this space.
Okay. Alex, you covered some of this, I think, before, but have you got anything to add?
Oh, I mean, I think for us, unlike my colleagues on the call, I mean, we're in a renewable business, right? So for us, we are in the sustainable business. That is why we founded the firm, and that is what we do. I think the challenge for us is it's very easy for us to kind of rely on that, right, without actually doing the work that we need to do around the areas of ESG, S, and G to be able to prove it to investors and be able to have that dialogue with investors. So we are in the business of sustainability. We need to be able to communicate what that means in terms of performance, and we can see our performance is strong, and what it means to be in terms of better guardian of capital, better stakeholder in the community. We have hard assets in the community. How are we interacting with the community around that? How is our workforce set up to be a guardian of capital sustainably for our investors? All of those are kind of big questions for us, and ones we keep trying to answer.
So okay, so let's move on to the next topic then, which is these sustainability initiatives that we're all talking about, but obviously from different perspective, because the businesses that you all run are very different. You need strong management, and you need basically to build a good corporate reputation, and that's very important in terms of attracting and retaining talent. So I'm sure no one would disagree with that. Then you look at the other side, which is the P&L side, if you like, the financial side. How do you balance everything that you're doing and still maintain financial performance that you think is acceptable to shareholders? So who would like to go first on that? Or am I going to pick some? Okay, go on, Alex. Go on.
Because I don't think the question is right? It is not balancing P&L against these initiatives. The premise is wrong. The initiatives themselves deliver better performance, for sure. Thinking about your activities in a sustainable way, whether it is, having the lowest carbon in terms of a data center, whether it is, running very efficient technology, or whether it is, having hard assets which are balanced in the grid. That is an initiative which delivers better profitability and better income for our shareholders. So I disagree with the premise. It's the same thing. To be a good custodian, one needs to take on board ESG and integrate it into the business.
I think the question was asked more from the framework of investors looking at businesses, wondering how you can have the best of both worlds, and the answer is that you can, right? So, does anybody else want to add to Alex's comments?
I would say that, I think Alex nailed it there, but just to add to it, people join because we're doing great things, and great things for us come with multitude of benefits. So we're, our engineers join us because we're innovative and we're doing innovative technology, and that innovative technology leads to sustainable technology, which is also cost saving, and it's also energy saving, and it's also time saving. It's all kind of a virtuous circle. If you're creating the right atmosphere and the right mission, then I think that it's easy to do both, especially when you're in tech.
Right, Heather, have you got anything to add to this?
Yeah, I think if I think about us as a company, it is really what drives our business and our sort of our revenues and our profitability. If I consider what we do in India, where the majority of our market is, not only are we helping them solve the problem where they suffer significant losses due to theft of electricity, people not paying the bills. So our technology was designed specifically really for India, for the Indian market, to address those problems. And we've worked closely with the government for 10 years to help them to address these problems. And in addition to that, if I consider, throughout, we've always sort of kept in mind the, Prime Minister Modi's mantras of skill India, make in India. So that's why we have, our technology we've developed, we have it made by manufacturers in India. We've created jobs, 60-odd jobs in India at present, obviously more over time, throughout. So not only are we helping address those problems, but we're also keeping all of the requirements of the Indian government in mind, and all of that is driving our revenue and business model.
Okay, thank you very much. So let's drill down to the next level down. So if you look at the stock exchange green economy mark, there are basically three elements that I think we'd all agree are incredibly important, which is climate change mitigation and adaptation. There's waste and pollution, and there's the circular economy. When you're running your businesses, how do you decide which of these three are the most important, or how do you prioritize your initiatives in these areas? And then the second part of the question is going to be, how do you communicate what you're doing clearly to investors? A lot of investors, I think, understand ESG as a big word. They don't probably understand, maybe in many cases, exactly what it means in terms of the adding value to the business, but they do understand what it's about. Your job is to assess how you're going to attack each of these areas. So would you like to start off with that, Alex, to begin with, as you're the most in-depth in the industry?
Ooh, thank you, Richard. So what I think the circular economy is, I think of course all of them are important, right? We are in a very difficult situation, right? We have, no one, I think, has seen the summer we all saw, right? We know there's really significant problems, and those problems are causing real live effects in terms of stability in our economy, and our energy system, which is the business obviously we're concerned with. This winter 15% of households in the UK will choose between food and heat, which is staggeringly terrible. Our assets we aim for our assets to deliver electricity when it's needed, therefore lowering the cost of electricity, keeping the grid balanced. So, those things around energy system volatility, around climate change, are very important. and enable us to deliver a very good return for investors. I want to pick up on the point you made about the circular economy. Circular economy is very interesting. Our assets are complex, and there's lots and lots of things within them. And so our assets should last 20, 25 years with components being changed. But there's very dangerous materials in some of those assets which need to be taken care of correctly. So we, as a good investor, want to make sure that we have the capital and the arrangements in place at the time of investment. So 20 years hence, our assets are decommissioned correctly, materials are broken down, reused if possible, or disposed safely. So that is the right thing to do as an investor, because we'd open ourselves up to liability. And it's the right thing to do as a custodian of sustainable capital to make sure that our assets are actually value add to the environment. So, picking on those two things, there's lots within that, but they all become then the same thing. They become integral to the business decision.
Okay, so maybe move on to Ian. Coming at this from a completely different angle, what do you think of how you prioritize what you do? We'll talk about how we communicate to the investors in a second, but why don't we go through your thought processes running the business and how you handle these three issues?
When it comes to the scale of carbon pollution in the media sector, it's equal to the aviation sector. It's huge. It's a big thing. No one really talks about it. In fact, it's getting talked about a little bit more now. But the major guilty parties are the streamers, the ones that are putting out the large amounts of content over the internet. It's those guys that really have to start really focusing on this, and I think they're starting to, and I think that companies like ours can kind of bang the drum so that they can really kind of shame them into doing things. But what we can also do is actually start to work with them on innovation of codec and efficient streaming technology. So that's something that we would look at as well. When it comes to how much of a part Blackbird can play in reducing the overall scale of the carbon footprint of the media industry, it's quite small. Video editing is not, post-production is not the major guilty party. But what we can do is start to really to vocalize the scale of it, and also start to innovate around producing codecs to bring that down. So yeah, we were likened to bringing a knife to a gunfight at some point recently by a journalist. I was like, well, I'm quite happy with bringing a knife to a gunfight if it helps to kind of to bring everyone's attention to it and bring it down. So yeah.
I think what you just said about the scale of the pollution would surprise lots of people. Can you just elaborate a little bit more on that point?
Yeah. So the scale of the carbon footprint of the media sector. Mm-hmm. Particularly not so much production, although production is a significant part, but particularly distribution is of the same scale as the aviation sector. Yeah, it's depending on which data, and I said before, data is not particularly reliable. You believe it's between 3 and 5%, so it's huge.
Okay, Heather, I think we'll move over to you for your comments.
Yeah, so I mean, I think our actual industry is an industry that is helping to address some of the problems like this, which is why we were accredited with the Green Economy Mark, because the technology that we sell actually helps with the carbon footprint, and that it, just by automating the entire system, it means that there's less people driving around. You imagine the size of the meter market in electricity meter market in India, and if you've got meter readers driving around all over to take meter readings and all the sort of manual side, and people going out manually to go and pay their bills, you just think about how that has been addressed by automating the whole system. So I think just our actual industry is something that is already looking at addressing this problem.
Okay, so let's just move on to the second part of that question, which was, how well do you think you are communicating what you're doing to shareholders? And do you think this is a situation that is improving, or do you think that you've reached a level of communication that's balanced? Okay, Ian, why don't you go first on that?
I would say that our shareholders have absolutely bought into the fact that it's part of our DNA, and we communicate it at every opportunity that we get, because it's very important, really, to to the team. It's very important to me, and it's very important to everybody that works for the company, so that we continually drum it into the shelf. So we know that there's importance. I think they bought into the fact that Blackbird is, flies the green flag for sure. In fact, with the IABM awards that we won in December was actually created because of the efforts that we've made in the industry. So it didn't exist before. So we kind of were there to kind of really kind of raise the issue for the sector. But yeah,
excellent.
It's a key part for us.
Alex, anything to add?
Yeah, I mean, so we recently published a full ESG report, right? A separate report that went out. I recommend everybody should read it. And I think within that, we put an enormous amount of effort. We have dedicated full-time members of staff who are focused on, understanding what we're doing. What are the metrics? Carbon, renewable energy, what are the metrics in society, what are the metrics in governance, and then matching it up against these, to be honest, quite complicated reporting formats coming through from the EU and the UK and the UN. So no, I think that was our first standalone ESG report. It will not be the last. It will be an ongoing activity. And so we aim to get better and better.
Okay, thank you very much, Heather.
I think we probably can do more to communicate it. I think we take for granted that people sort of know and understand what we do, but I think we probably can do more to communicate, especially as it's becoming more of an important topic. Every year, obviously, ESG requirements in terms of annual reporting are growing, and we did put a lot of effort into this year to really try and get the message across in our annual report. But I think it's something that, as the other two have said, that I think we can certainly continue to improve as time goes on.
Yeah. To Alex's point, actually, we've also put out we aim to put a white paper out every quarter with the company, but we have put 2 out on the environment, and not just the impact that we have, but also the impact that the industry is having on the whole globe. So yeah, I think it's really important to kind of communicate that really in depth with some detailed studies and data. To get the message across.
Okay, thank you for that. I'm going to ask a quick question about M&A activities. Do you think what we're talking about today, essentially sustainable finance, is actually impacting valuations in the market, or do you think people are more concerned about the more traditional metrics? Have you seen any evidence where this has caused activity to change?
Well, I would say there is a range of investors who view ESG as important enough to them that they won't invest unless the company has adhered to a set of standards. And so the logical conclusion on that is, if there is a smaller universe of investors who wish to buy your share, you will not have a high valuation as you would if those universe were available to you to buy that share. So for sure. Anybody else, any comments on that?
I think it's Alex is right, and it's going to become more important. So yeah, it is absolutely right on a number of levels, and it will absolutely drive share price going forward.
Okay, so we're going to conclude with a general question for you all, which is not about your company, but it's about your sector and the attitude of your competitors and other component members of your sector. What do you think they are? How impressed are you with their attitude towards sustainable finance initiatives, and what really should they be focusing on to improve matters if they're not? Would anybody? Why don't we start with you, Heather?
Well, I think I do see it in our sector, and as I say, I think our sector is really one that's trying to address this. But for example, we are in the UK smart metering contract, and even within that contract, we get audited according to our various ISOs, which are all very relevant, including, as I say, the environmental one, all very relevant to, to ESG. So, and this contract actually, this contract was signed a couple of years back, and the fact that it's a contractual requirement for everybody to have certain compliance in place. So I think our industry is very much looking at it already and addressing it. We certainly see within our supply chains, and we try and do it as far as possible by only dealing with very reputable companies. Many of the companies that we deal with are huge global companies that already have, ESG requirements, many of them being listed in either the UK or other stock markets. So within the whole industry that we deal with, I think it's something that is very much at the forefront of people's mind.
Okay, well, look, thank you very much indeed to you all, because that concludes the panel discussion. I'd like to thank our speakers and our audience for attending the forum. Thank you very much.